After you've purchased your first few ETFs, a natural question you might have is what proportion should I put into each ETF? How much exposure should I have in one area versus another? Generally, when I get this question, I suggest people have a look at, say, superannuation companies in terms of how they've proportioned out their holdings in terms of Australian facing or international facing. But what if you're someone who wants to operate at a slightly higher level and you want to play around with a couple of combinations of having Australian focus, international focus, fixed income versus equities versus currency hedge, not currency hedge. And if you tweaked a few proportions, how would it impact your returns or your fees? So the website is bdshares.com.au/portfolio builder. You will see this page. Don't stress too much. Get past it as quickly as possible. The information you put in here is not really relevant. You can tweak it. So I usually just put in $10,000. Start from scratch, 1990. It doesn't really matter. It's just for the purpose of, I think they want to get some stats on it. So once you get to this page, this is where the action is. Now you can put in your sample portfolio. So let's say you want to start with a high growth ethical investment type portfolio. You click it, you say you want to put in $10,000. Let's bump it up. Let's be conservative with our bump up. Let's make it 50 grand. And it will automatically tell you these are the weights that they are suggesting. So this is just their initial suggestion. It's up to you if you want to use it or play around with it. So 54% in the international facing one, 36% in the Australian facing one. That's about right. That's what most companies will say is have more internationally facing than you have domestically facing. And then if you also want to have a bit of fixed income component in there, have some bonds in there. So you can now see they're saying you'll have 286 stocks, 56 bonds, and here is a little bit around the performance. So we're now looking at, in the last year, a 12% drop, but over the last 5 years, you would have seen about an 11% return annualized. Your distribution yield in the last 12 months was around 4.7%, and your fees, composite fees, this is where you combine everything together in your portfolio, you would have seen about a 0.55% fee structure, which is about $275 a year. So that is very easy to do. You're just looking at $50,000 multiplied by 0.55 divided by 100. That's where the 275 comes from. So if you scroll a bit further down, you can see a little bit more around your portfolio or your projected portfolio in terms of asset classes, the countries you've got your holdings in. Portfolio characteristics is where you can just see some of the companies you have a holding in. Remember, this was an ethical breakdown, so you don't have the usual suspects like Google or Amazon in there, or Facebook in terms of Meta. Then the next key couple of sections is where they will show you how this theoretical portfolio would have performed against a couple of key indices. So the MSCI World Index, I think this is the one the VGS tracks, excluding Australia, and the S&P 200 Index, which is the local one, which like something like A200 would track. And your total return, the terminology tells me this is assuming you take your dividends and reinvest them back in. So looking at this graph, I can see if you had invested back on the 29th of December 2017 and you held it, you would have been outperforming all the major indices up until the start of 2022, when I suspect this is mainly the international holding dragging down your position. If you scroll down a bit further, you can see what your hypothetical returns would have looked like if you had made the investment at a certain date and never touched it. So a year ago, you would have been at a loss, 2 years ago, and all the way up to 5 years ago. So this is where I'll call out, this is saying you put your money in and you never touched it, which is not as realistic, I think, as what most people are doing is they buy some shares and they'll keep buying shares. So that's where I would say one of the weaknesses are. Now, the real power of this platform is if you want to now tweak things around, try a few different settings. So this is where I would say, let's say you want to add in a comparison one, duplicate current, and I know something people would be tending towards is probably dropping the fixed income component. And instead of ETHI, let's say you want to add in something like an NDQ, a heavy hitter like NDQ, but you've lost your ethical filter. And now we need to make it up to being 100%. So do some quick maths, 64%. Then leaving everything else the same, 50 grand, 50 grand, hit generate report, and you can instantly see the comparison. Obviously, you've lost the fixed income component. In the last year, you've had poor performance because NDQ did get dragged down quite a lot because they had a lot of the tech companies in it. But overall over the last 5 years, you're higher than you were in the previous portfolio example. Composite fees down a little bit more. And we scroll right down, look at your holdings. We're bringing back in the Amazons, we've brought back in the Googles, we've brought back in the Facebooks. Obviously, there's the ethical element has been dropped. And you can also see the performance return. This is the key one, right? So your first portfolio, I didn't label it correctly, so it's just called first portfolio. There's the one we were looking at before. And now your new portfolio, you've actually outperformed and you've held yourself up against it. Scroll further down and you can see how your dollar numbers would have fluctuated over the 5 years over different settings. So another thing you might be tempted in doing is saying, I want to add in an element of currency hedging. So NDQ by itself is a bit too naked. Let's say you want to add in a currency hedge in there as well. So let's make this now 32. You want to go 50-50. 32 NDQ and 32 the hedged version of NDQ. Generate the report. Again, now you can see, you've done quite poorly because the currencies have not worked in your favor. So having a 50-50 hedged, unhedged approach to NDQ would have ended up you resulting in achieving basically the same total returns as the recommended ethical holding. So now I will call out a couple of the weaknesses of this platform. At no point did you see variability or the risks or the volatility of your investments. Now that's something sometimes people want to know, is the higher the standard deviation, the higher the volatility you might experience on this journey. You can sort of see it in terms of the returns graph. If it was going up and down a lot more, considering these are total returns, it might not be that volatile, but that's something to be conscious of. The other thing, like I said before, was you're only looking at BetaShares products, which is fine because I think BetaShares does have a reasonable selection, but it would be handy if there was something out there that did, all ETF companies. Maybe that's something for you to build if you're a tech guru. And the last weakness I found with this is it doesn't help you if you are trying to project what it would look like if you had invested consistently into the share market as well. Because that's what most people will do, is you're not going to necessarily put a certain amount in and not touch it. I imagine a few of you want to put a certain amount in and then keep adding a few $1,000s every month or so into it. This model doesn't let you take that into account. It's still better than nothing, but your outcomes will be significantly different if you are investing amounts in over time as well. So I hope you enjoyed that video. See you in the next one. Bye for now.